Hi guys, and welcome to another week ahead video. Now, in the last week, we had some very interesting comments from both the BoE Governor Mark Carney as well as another MPC member named Tenrero. And between the two of them, they had some pretty dovish things to say, which has basically increased the market's expectations for possible easy monetary policy as well as some stimulus from the BoE somewhere in 2020. Now, that is the reason why our main focus for this week will be on the pound, and more specifically on a couple of economic indicators that we think can provide us with an opportunity to trade the pound in this week. So let's jump to the video now and see exactly how we can prepare for these events and hopefully trade them in the upcoming week as well. Okay, so looking at the baseline for the pound. Now currently we do hold a bearish bias on the British pound for the following reasons. Firstly, the potential risk of a messy Brexit has been put back on the table. This happened after PM Johnson's government took a more hardline stance towards the December 2020 transition deadline, saying that there will be no extension after December 2020. Now, this basically means that the UK will either have a deal by December 2020 or they will need to leave on a free trade basis with the EU. Now, the uncertainty regarding a possible messy Brexit is one of the key reasons why we saw such a sharp decline in the pound following the UK general election gains. And so far, the rhetoric from the EU side is highly doubtful that there is enough time for any meaningful deal to be struck between the two sides. So that is really one of the reasons why we saw a lot of weakness coming into the pound. And the likelihood of another roller coaster ride for the pound this year is increasing day by day due to the possible back and forth trade deal developments between the two sides. Now, secondly, even though the market's focus has been solely on Brexit, the BoE and monetary policy has suddenly come back into the spotlight this week. The reason for this is earlier this week we had Governor Carney coming out saying some pretty dovish things, explaining that the UK growth has slowed to below potential, and also added that the MPC is currently debating the merits of near-term stimulus. Now, we also had another dovish development from comments made by BoE's Tenrero, and she said that her inclination was towards a rate cut if the downside risks were to emerge, and added that the risks are tilted to the downside at present. Now, she also echoed Governor Carney's comments on easier policy, basically saying that more stimulus will be needed in the event that growth fails to recover. Now, we also need to remember that the MPC had two members voting for rate cuts in the previous two rate decisions. Interestingly, the two previous dissenters were Haskell and Saunders. Tenrero wasn't part of that, which means that Tenrero is now an additional member that is potentially in favor of softer monetary policy as well. Then looking at the baseline for this week's risk events, with the market's attention now turning towards potential softer policy by the BoE, we think that this week's data may be more interesting than usual for the markets. Now, first up on Monday, we have two important ones in the form of quarterly business investment as well as GDP. Now, the bank has cited slowing growth as well as low business investment as key factors that they are concerned about at present. And if we see a further drop in either of them, that should feed into the current negative sentiment on the pound and could increase market expectations for potential easing from the BoE in 2020, especially seeing that both Carney and Tenrero mentioned slowing growth as a big concern for the BoE at present. Now, GDP month over month is expected unchanged at 0% and yearly expected to tick down to 0.6%. And we can see that the GDP has been on a trending basis moving down low, with the last reading coming in with the lowest number from 2012. So there really is cause for concern in terms of growth. Then on Wednesday, we also have a speech from BoE Saunders accompanied by CPI. The latest releases of CPI was less inspiring, coming in at 1.5% for the headline, as well as which was basically the lowest reading in 3 years. And we also had core CPI coming in at 1.7. Now, both measures are currently firmly below the BoE's 2% inflation target, and is basically moving in the wrong direction if we have a look at this chart on a trending basis. So both CPI measures are expected to remain unchanged in this week's reading. However, some investment banks have cited that there might be potential upside risks for the headline numbers, specifically due to December's unexpected rise in oil prices. Now, we're not really expecting a lot of fireworks from the speech from Saunders, but seeing that he was one of the MPC members who voted for a rate cut at the prior two meetings, the remarks might carry more weight, following on from the comments made by Governor Carney and Tenrero earlier this week. Then finally on Friday, we also have retail sales. Now, we did see quite a very big drop in the November numbers, And due to that big drop, the market is expecting some form of a rebound in the December data. Markets are expecting retail sales year over year to jump back to 2.7% from 1%, and for core retail sales year over year to jump to 3% from 0.8%. Now, even though majority of analysts do expect a rebound, there are some investment banks who say that there are signs that Christmas spending and sales were poor, which means that there is potential downside risks to the December data for retail sales. Then looking at some possible sentiment shifts, let's start with the possible dovish shifts. We will be looking at possible dovish shifts to occur basically from any surprise, big surprise, negative deviations for the pound data this week, more specifically on the GDP and the CPI numbers. A further deterioration in growth will probably feed into the current negative sentiment in the pound and could create some great short-term selling opportunities. We also need to watch out for that speech by BoE Saunders. If we see a third BoE member making an overly dovish comment, it could see a further climb in expectations for potential softer policy and stimulus by the BoE in 2020. It'll also be important to see how these events change the rate cut expectations to evaluate the significance and the sustainability of any moves resulting from these data points. Also, keep an eye open for any major negative developments between the UK and EU trade deal negotiations, as that would also add fuel to the current negativity. And for us, for the biggest conviction trade in the pound this week, to the downside, we would want to see a miss on all the key data points for this week, accompanied by negative trade deal developments or announcements between the UK and the EU. Then looking at some hawkish sentiment shifts, given the dovish comments made by the BoE members this week, it'll take a lot more from the data to see any meaningful upside in the pound, even if we do see surprise deviations. However, seeing that both growth and business investment has been a key point of concern for the BoE, we might see a reduction in rate cut expectations if we see any major surprise deviations to the upside in these important data points this week. Now, all the dovish comments this week pointed to further deterioration in growth. Thus, if we see a turnaround in growth, that would mean that there is no more need for stimulus, at least in the very short term. Thus, any data point or series of data points that cause the markets to basically price out some of this week's more dovish comments, that could be considered as a potential short-term hawkish shift in the sentiment for the pound. Now, for the biggest conviction trade in the pound this week, to the upside, we would want to see a beat on all the key data points for this week, as well as being accompanied by positive trade deal announcements between the UK and the EU. Then looking at some potential currencies to pair the pound with, in the case of a dovish shift on the pound, we could look to pair the pound against something like the Canadian dollar, which has been supported in the past 2 months by a more upbeat tone from the BOC, as well as a big jump in oil prices in December. One thing to keep in mind is if you look to pair the pound with something like the Canadian dollar, just make sure that you are trading in line with the current risk tone at that time, as a positive or a negative risk tone will affect the CAD. Also make sure to keep track of oil prices, as it's another idiosyncratic factor for the Canadian dollar. Then in the case of a hawkish sentiment shift on the pound, we could look to pair the pound against something like the US dollar, which has been trending lower from October 2019 due to a string of negative data points, as well as market expectations for further easing by the FOMC in 2020. Do remember that these recommendations are based on the current sentiment at the time of making this video and can obviously change throughout the week. So make sure to reevaluate whether the sentiment is still valid before taking any trades. Now, these type of sentiment shifts are valid for trading phase 1 trades. Now, if you want to learn more about phase 1 trades and how they work, you can check out our news trading strategy playlist on YouTube, where we post weekly trade examples of how these trades play out. Now, after a phase 1 move, we can also look for a potential phase 2 pullback of that initial move, and we do post updates on these moves inside our tradable sentiment shift report inside the Forex Source terminal under the Market Insights tab. Now you can see each day which sentiments are still in play and which ones are still valid for trading the phase 2 pullbacks. And you can also learn about how these setups work during our live analysis webinars each day inside the Forex Source terminal.